How's it going, everybody? It is Dennis, and we're back with a video talking about Trump's tariffs and how I am trading during these times of volatility, high volatility, and how am I keeping my account stable to an extent, especially with someone who uses margin to a large amount of margin, to 50% of my account value. And how am I trading these times? What am I doing? What am I trading? What am I buying? What am I selling? Overall, how's my portfolio looking? And first of all, of course, love being transparent as possible. I'm down 42.37%. I'm not afraid to talk about it because that's just how the market is. There's not much I could do. I'm trading a strategy which is high risk, high reward. We're trading poor man cover call strategies. We have high yield ETFs. We have triple leverage ETFs like TNA that we're trading on. So of course, we're going to have a lot of movement in our account and a lot of volatility. And with that volatility also comes high income when that possibility is available. We're down 42.37% year to date. We're down on the 1 year by 16.3%, and we're down on all time of 8.21%. So we have dipped down into the cash original amount that account started with. But I'm still continuing to trade. I'm still continuing to earn income. I'm actually earning more income than I was before with some strategies compared to others, and that's because of the high volatility market that we have right now. And one of those ways are through S&P contracts or SPY contracts. And this is a contract that I just rolled over to next week of April the 17th, as you can see over here on the bottom. Today is April 10th, the time of recording. The video is going to be out April 11th. So this is next week's contract going to the next week, Thursday, because Friday we do have off, I'm pretty sure, on the markets. So Thursday, this is when this will be expiring on the 17th. And for this contract roll, so there's two contracts I was able to roll for an 0.85 delta or 85% chance of profit. And for that, I was able to earn myself $544, as you can see right here. $544 6 hours ago. I'm recording this at night right now, but $544 is how much I have earned for this roll that I did for next week on April 17th. And that is pretty much 2 times the amount I would earn for, or not 2 times, yeah, 2 times I would earn amount in a week, or that will take 2 weeks usually for a trade. At 0.8 delta, 0.85. The 0.85 delta would probably be 3 weeks of trading to make that amount. For 0.8 delta, it'll be around 2 weeks to make that amount, because I would usually make 100 per contract. So 2 contracts, 200, 400-ish. So a week and a half, 2 weeks, 2 weeks and a half to earn that amount. And with this, I was able to do that with just 1 week of trading. 1 week trade at 0.85 delta, so 85% chance of profit. And I was able to make myself $544. This is good, but it's also risky. I say risky because, of course, we saw what happened a couple days ago. We saw the market jump up, like, I think by 8%, 9%, right? We had a huge jump because we had crazy news coming out of a 9-day pause, and then we had a dip, right? So I should have rolled that yesterday. Technically, I should have rolled the day this being filled on Thursday. The event happened on Wednesday. I should have rolled yesterday. Up and over. I would have probably got more of a payout for 551, but hey, what can you do? I was trying to, calm down a little bit, see where the market goes, and the market ended up dipping today on Thursday, the 10th of April. And of course, we'll see what happens on Friday, but I decided to take the trade today because I don't think the market's going to go up on Friday, April 11th, the time of this video. And we can see that right now on the market trading overnight market, we can see down over to my market that the market is going down. The S&P is going down. It's down 0.82% overnight. It is rebounding a little bit, but I doubt a rebound enough to make a difference for my contracts. And even if it does rebound for me to make a difference for my contract, so if it reaches that 551 price, I'll just roll over to next week for less of a profit, or roll over to the week after for less of a profit. Probably for maybe $100 per contract, which is my usual amount, because of the high volatility. And even if I don't roll for 100 a week, or for $100 per contract, then maybe for 50, I still made 2 weeks worth of work from my contract. So I'm still up, even if I roll over for like minimum amount of payment for next week for like 50 to 25 a contract. I'm still up on that 2 weeks of work that I missed out. So that is one way I'm trading. I'm trading S&P contracts, continuing to trade S&P contracts. I'm also continuing to add in cash into my account. As you can see, we're at $3,226.77. We have 26% buffer. Before we did have roughly 40%, but as you guys may or may not know if you follow the channel, I did sell 2 of my positions in DHS and another position to go ahead and purchase another contract in the S&P 540 call, which I did buy early, thinking of it now. That is because, you know, the market went down. I could have bought it for cheaper in a better position, but we bought it for $540 for roughly $7,000. A little bit early. Could have waited a little bit. Well, who knew that this would have happened, right? So now we're saving up for a third contract, and that third contract, I'm still thinking what I'm planning to do with it. I don't know if I want to buy another, like, let's say another 7K into a contract. Right now, I'm trying to not be risky, but be risky at the same time. So I'm looking to get another S&P contract at 540. I'm looking to just add into this position that I already have. So I already have this position right here, 540, expiring on March 20th, 2026. If I buy another contract of 540 at around the $4,700 mark, I'll lower my average cost, which means I lower my break-even price, and I can trade more aggressively on that contract that already exists. So that's very good to see. But of course, that also gives me a little bit of risk of being assigned, because currently S&P is at 519 overnight and my contract's at 540. So it gives me a risk of being assigned. But this is a whole year out, or 52 weeks out. So yes or no, you know, it's risky, it's not risky. But another risk for me right now is margin. And margin is a big risk that everybody's talking about, and everybody's having issues with it. Even the big guys, the hedge funds, are having an issue with margin. And of course, I do have margin taken out. As you can see, my margin used is $25,423. My total account value is $30,000. So currently it's about to be 100 to 100, right? So 1-to-1 value for margin in my cash. So that's a little bit of an issue. That is why I've stopped taking out margin on my account. I've begun to just keep cash, hold cash. The reason being because we don't know where the market's going to go. The market might continue to go down, and I don't want to increase my margin spending if the market continues to go down. Of course, if I increase my margin spending and a dollar cost average into funds such as SPYI, JEPQ, QDTE, YMAX, I'll earn an income which will then increase the amount of cash I have. But in the same time, I don't think it'll be fast enough to pay off the margin that I have, or I'll be adding on. Right, so I could decrease my margin to 25% of the total cash I earn weekly. Right now, it's at 50% of the total cash I earn weekly. If I decrease to 25%, of course, it'll be a little bit safer. But in total, for now, I just want to wait a little bit before I start using margin again. I'm going to wait a little bit, increase my buffer, see if I could get up to like 30-40% of buffer. So add cash into it. If anything, of course, I have positions to sell. I have RITM, I have HTGC. These are old positions that I have. The cash is just laying around. They're all on positives and profitable because I bought these back in COVID. So if in case of an emergency, I could always sell out of those positions to make up for the margin buffer that I need. But currently, we haven't needed that. Currently, we're staying stable around the 25% mark on margin. Before we were at 30, so it did dip down below, especially since now we're dipping into the cash territory of my account. But overall, we're continuing to stay to the same strategy. So SGLV, I talked about this in the video before. SGLV, we added $500 into this, or 5 shares. So currently it's sitting at $1,008, and we're up roughly 0.06%. Of course, bonds are going up, bond yields are going up, and that is because of many reasons. Many people are saying China is selling American bonds, or Japan selling US bonds. There's a lot of things that are going on. People are saying the reason that we did have the Wednesday boom in the market and the 90-day wait time was because Trump got scared of the bond market, but we can't confirm or deny that. He said it's because people got scared. Maybe he got scared. Who knows? But currently we are sitting at $1,000 at market value for our bonds. It's earning us a little bit of income. This is just a place for me to put cash into. This is another position I could sell just in case of an emergency. Currently, the maintenance requirement is 25%, but if you know that if you sell this off and turns into cash, the maintenance requirement is 0%. So then you get a 25% boost onto your margin requirement, meaning it'll save me a little bit of time in case of an emergency. We also have SPYI. I'm continuing to go ahead and reinvest dividends into that. We are actually getting dividends this week, as you guys may or may not know, from YieldMax ETF. We're getting AMZ and Amply dividends. So AMZ is earning me $154.36 this week on 48.77 distribution on 316 shares. As you can see, I have not been adding shares into AMZ. I have not been adding shares into Amply. I've been adding shares into SPYI, into JEPQ, into QDTE, and into YMAX. So in a way, I've also been keeping cash on the side and buying contracts as well. So in a way, you could say I've been preparing for something like this in the market since February. As you guys know, I made a video saying I'm preparing by having JEPQ. I'm preparing by having SPYI. And then I made a video that I'm preparing by having SGLV. So I've been thinking about the idea that a market might have a downturn with this new presidency, or with the new president and a new group of people we have in office. So I've been preparing. Have I prepared the best by maybe having, reverse funds and having funds that gain on the downturn of the market? Or maybe did I hedge my positions well enough? Or did I go into safer positions just like going into all in SGOV? Maybe not. But that is because I still want to continue to earn dividends. I still want to continue to earn income and continue to grow my account even in downturn markets. So these $154 and these $91, so $154.91 around around 240-ish, 230-ish dollars earned from these monthly paying ETFs will be going into either SPYI, into JEPQ, or maybe just holding into cash. Not sure just yet. I just want to see where the market goes. Of course, like I said, we are at $3,226 of cash, so technically this will be another addition up to 3.5 roughly. We also got our YMAX dividends of 80.78, so that will boost us up. So 80.78 add with 90, that's roughly what, 170-ish, 170 plus 154, that's roughly 320-ish, right? 320, 30, something like that. And then we have QDT of $44.14, and that in total bring us to like $400 made for this week from dividends alone. Those $400, if added into our cash pile, would be up to $3,600. So we would have $3,600, meaning we'll get closer to being able to buy maybe another contract and lowering average cost. So there's a lot of things we could do, a lot of moves we could do. If we do end up going for the contract purchase, that will tank our margin rate, because of course contracts are very hard on margin buffer. They're not 25% maintenance requirement. I'm pretty sure they're almost like 50-75%. They don't really disclose what it is, but I'm pretty sure it's around the 75% mark if I'm not wrong, for margin requirement for contracts on Robinhood. So we were to go in that route, it would hit on our margin buffer quite strongly, but also would increase our income by roughly $400 a month, meaning we'd be earning more as well, meaning we'll be able to increase that margin buffer by a lot, meaning that technically the recovery would be a little bit faster. And there's a lot of things that go into it, but currently it's either three things. We go into SPYI, we go into JEPQ, or we buy another contract on SPY, another poor man covered call contract or a LEAPS contract. But the reason, like I said before, the reason I'm going into SPYI, or I might be looking to go more into SPYI and then more into JEPQ, is because of their trends and how they've been performing in markets like this. As we can know, YMAX, QDTE, all these high yield ETFs, they've been performing a lot worse compared to these funds like SPYI and JEPQ. If you take a look at SPY is down 11.72% year to date. SPYI is down negative 12.10%. But SPYI has paid us 51 cents, 51, and 50 cents, so a total of $1.50 per share. So they've paid us $1.50 per share. That makes up for, that actually leaves us higher up on the percentage scale than it does with SPY. Also, if you reinvested those dividends, you also increase your amount of shares, and with those shares, you increase the amount of dividends you earn, and therefore you are technically now beating the S&P. With JEPQ, it's a similar story. We're down negative 14.25% year to date. QQQ is down negative 14.05% year to date. JEPQ has paid us 45 cents, 45 cents, 48 cents, and 54 cents for April 1st. So that gave us almost a total of $2 paid out for this year alone. And of course, that also helps us beat the QQQs, especially on the Dow market. If you're adding shares in, you are beating that by a higher scale. So it is consistent dividends. It's also growing dividends, seen as the JEPQ, and it's also consistent bounce back. So as we can take a look at SPYI, when we were sitting here on negative 15.99, we bounced up back on that market rally on April 9th, to negative 8.59%. If we took a look at SPY, we're down negative 15.76%. We bounced back to 6.92%, right? So pretty similar percentage bounce backs for both JEPQ and SPYI. As you can see, negative 19 to negative 10. That's a 9% bounce up. And then we can see negative 19 to negative 9. So this is 10% bounce up. So it's 1 to 2% less than of course, the market itself, the overall market itself. But you have shares to go ahead and counteract that and earn your income on a monthly basis. And of course, it also is safer or less volatile than the high yield ETFs. So that is the reason why I'm investing in SPYI, while I'm going to JEPQ, while I was already doing it beforehand. As you can see, our portfolio diversity for these funds is already at 4.44% for JEPQ and 3.98% for SPYI. We're going to continue to buy in them. We're going to continue to invest in them. And the reason is because we don't know where the market's going to go. And I would rather have something that pays me dividends and I'm able to take that money and keep it in cash to have a better margin buffer, or take that and go ahead and reinvest back into the funds and earn more and more and more and more. So when the downturns end and the market stabilizes and we're continuing with our uptrend in the markets, or we have another bull cycle, that we're able to run up faster because we dollar cost average down, and we also have more shares to earn more income. And when this dividend income grows, because when the share value grows, the dividend income grows as well, dividend distribution grows as well, we will be earning higher dividends as well, and the returns on yield will be way higher than when we were invested originally. So wins on wins on wins, but just the only thing is now is to understand where the market goes and not to over leverage yourself. Right now we could see that we're over leveraged on TNA $36 call, TNA $34 call, but the $36 call is almost worthless. It's like $500 per contract, and we have 6 contracts. That's pretty much worthless. I'm pretty sure it's like down like 90%. TNA $34 call, also pretty not bad at $1.75, but also pretty worthless currently in its position. Of course, these are 3 times leverage, so say the Russell bounces back, we'll also bounce back quick. Of course, it'll be a little bit slower because it resets on a daily basis with these leverage products, so the bounce back might be a little bit slower. But of course, if there's a bounce back, it'll be nice. Also, we could always roll over. We're still earning income on TNA, even though the TNA earnings for this month of April were a little bit low at $100 only. But that is because I decided to stay safe at the $36 mark. If we decide to take a little bit more risk and trade to make $1,000 as we usually do, then of course we could go ahead and roll these contracts over, like this one that's in July 18th. We could roll that over to the end of the year or to next year July, and that will also lower our average cost. Lowering our average cost will then lower our it will lower our break-even price. I had to take a really quick look at the SPYY contract, but it'll lower our break-even price, and therefore we'll be able to be a little bit more aggressive with our trades and earn higher income. And if there is a bounce back, the bounce back will be faster, recovery will be faster because your break-even price is now lower. So there's different ways to go at it, different ways to do it. That is just how I'm looking at my portfolio. Of course, everybody else's portfolio is different. Currently, I'm doing what everybody else is doing, and that is looking at the 30-year treasury bonds or treasury yields, right? We're sitting at 4.9%. We hit we hit 5%, right, on April 9th. That's why, we're supposed to hit 5%, or maybe that was the 10-year. But we hit 5% at a certain point, and everything went to shit. Everybody panicked. And right now we're at 4.9%, and everybody's panicking again on Twitter. So it's not the best of times. It's not the worst of times. We continue to earn our income, continue to earn our dividends, our option income, continue to reinvest it if we want to, or we can continue to keep our margin buffer safe in case of more market downturn, more market bear market times, and just see how this plays out. Really, the best thing you can really do in times like this is to keep as much money as possible stable. So pretty much keep as much cash as you can safe. Keep all your positions as safe as possible, and if you can, at least have something that's producing income. This is why I always say income producing assets are always the best assets, because even in the market downturns, your income will be coming in. Even if the income decreases, like in Yield Max, Roundhill, all these different funds, even if the income decreases, you're still getting income. Some income is better than no income. It's better than holding Tesla long term, like everybody said. I rather hold Tesla shares than I hold Tesla. But hey, Tesla's paying me income, AMZ's paying me income, and sure, they might have had depreciated a lot in value, but they will continue to pay me income, even if that income has depreciated with the share price. I will still have income that will boost my margin buffer, give me income to reinvest, and it's better than holding Tesla shares, which if you have to sell, you're not selling at a loss, or if you're not selling at a point where you want it to be because the market had a downturn. So that is pretty much it. That is how I'm trading this market. That was the positions I'm looking into it. So poor man covered call continuing on SPYI, continuing to buy more into SGOV, continuing to buy more into SPYI and JEPQ. Just more safe positions, trying to keep my accounts safe as possible and increase that margin buffer in case of more bear market times into the future. So thank you so much for watching, guys. Hopefully this 30-year treasury decides to go back down. The reason why this is a big deal, by the way, if you guys do not know, is usually when the 30-year treasury is going up, so are the markets. The reason is because that's inflationary. When treasuries are going up, it's inflationary, and therefore inflation also causes the market to go up. And usually you want them to trend at the same pace. As you can see, when we had the 30-year treasury going down, the markets were going down. But now the markets are spiking down, but the 30-year treasury are spiking up. So that is a very, very dangerous place to be. Usually they kind of trend with each other, or in most cases the treasury just stays stable or the market goes up, depending on the time in the point in our markets or economy. But you don't want to see the treasury going up and the market going down. That's very, very bad. So hopefully that balances out. Hopefully we get some good news coming in from Trump and his administration, and hopefully everything turns out well. But currently it doesn't seem like that way. But we gotta stay positive and look for a future market where everything's green, like it was yesterday on Wednesday. Hopefully we could get that again, but for more than just a day. So anyways, thank you so much for watching. That is how I'm trading these markets, Trump's tariffs times. And I'll see you guys next week for next week's update to see how we're doing. Hopefully the market doesn't absolutely murder itself and dissolve into pieces and crash into a horrendous flame of fire. But anyways, see you guys next week.